Okay, so let's start. We want to start a new topic. And our new topic is called financial instrument. So let me introduce it. First, we want to define what is a financial instrument. But before I define what it is, let me look at it from this perspective. Assuming you're a company A and you want to borrow finances to finance your business, you as company A, you could decide that you are going to raise finances by issuing shares, or you can decide you're going to raise finances by issuing debentures, or you could decide you're going to raise finances by issuing bonds. So you as a company, you want to raise finances, and those are different ways in which you can raise finances. Now, somebody somewhere or another company somewhere will have to buy those. For example, let us assume it's company B or a person B. This company B will be the one to buy your shares so that they give you the money you need, or they would buy your debentures to give you the money you need, or they would buy your bonds. Now, from this topic point of view, we normally refer to company B. As the investor or the lender. He is the one lending the money to company A. So he is the investor. Now, when he buys, that is person B or company B, when they buy shares in company A, in the books of B, they would have an asset called investment in shares of A. If B buys debentures of A, B in their books will have an account called investments in debentures of A. If B buys your bonds, in the books of B, they would have an account called investments in bonds of A. Listen to this now. So all these instruments, to B, they would create what we call a financial asset. To B, it's an investment. It's an asset. So all this instrument will create what we call a financial asset. On the side of A, we call them the borrower. They are the ones borrowing the finances. We refer to them as the borrower. If company A issued shares, then in the books of A, that will create what we call equity capital. If company A issued debentures or bonds, then in the books of company A, it will create what we call a financial liability. Why? Because you, company A, you have an obligation to pay back the 20 million. You have an obligation to pay back whatever the amount. Okay? So that's why we are saying to company A, it creates a financial liability if you issue bonds or if you issue debentures. It can also create equity capital if you, company A, you issued shares. Good. Now, so what is a financial instrument? Listen to the definition now. A financial instrument is a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. A financial instrument is a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. Listen, to the investors, it creates a financial what? Asset. To the borrower, it creates either equity capital or financial liability. So I've defined what's a financial instrument. It's a contract that leads to a financial asset to one party and a financial liability or equity capital to another party. We have said to the investors or the lenders, it creates a financial asset. To the borrowers, it creates either equity capital or a financial liability. Good. So before we continue, listen to this. I know we have a new students today because today is a free class, so I want you to listen. I'm especially talking to the new students. Now listen, because I want to explain some modality about our class. Now, first, before I even explain the modality of the class, I would ask you, please subscribe. Please subscribe to my YouTube channel so that you will be notified whenever we post new videos to the YouTube. So please subscribe by clicking that subscription button down there. You can even do it as we are watching this video. You can click that subscription button. So please do it, that we may notify you, or you may be notified whenever we post new videos into the YouTube. So click that subscription button down there, and also you can click the notification bell. You can also click the notification bell. Good. Now, the point I wanted to talk to the new student is here. So for subscription, it's for everybody, whether you are my student or you are a new student. If you have not subscribed, please subscribe by clicking the subscription button down there. Good. Now we move on to the new students. Now listen. There are times when you may be disconnected because your Wi-Fi strength is weak for whatever reason. It keeps fluctuating. That's obvious. It's normal. So if you are disconnected because of your Wi-Fi strength being weak, how can you come back to class? If you click on the disconnected video and it doesn't bring you back to class, then there are other two ways in which you can come back to class. Number one, you can refresh your page. This page where you're watching the video from, you may have in your gadget, you may have a refresh button either on the top left or on the top right of your page. You may have a refresh button. So if you are disconnected, especially when you're watching a live video, for recorded ones, that may not be a big deal. But for live video, when you are watching and you're disconnected, you can refresh your page. Click the refresh button. That will bring you back to class. If your gadget does not have the refresh button, then you can go back to the group where the link was posted, then you click on the link again. You click on the link again. That means it's like you're joining the class again. So let me continue now. I think I've explained on how to rejoin the class. So now we continue with the topic. So I have already defined, listen, what's a financial instrument. So before we continue, let's put down that definition. So andika the topic, financial instrument. That's the topic, financial instrument. Then you say this, a financial instrument is a contract. A financial instrument is a contract that leads to a financial asset to one party that leads to a financial asset to one party and financial liability and a financial liability or equity capital to another party, and a financial liability or equity capital to another party. Another paragraph. To the investors or lenders, to investors or lenders, to investors or lenders, a financial instrument creates. To investors or lenders, a financial instrument creates a financial asset. Creates a financial asset. It creates a financial asset. While to the borrowers, a financial instrument creates. While to the borrowers, a financial instrument creates either. Financial instrument creates either a financial liability or equity capital. Or equity capital. It creates either financial liability or equity capital. Good. So that is it for that. So you now know what's a financial instrument. So let me proceed now. Listen now. How do you recognize? Now we are proceeding. Listen. How do you recognize a financial instrument in the books? That's what I want to talk about. Whether you are the borrower or you are in the investor, the moment you signed that contract, how will you recognize that financial instrument? That's what we want to talk about now. So we want to talk about what we call, don't write this, we want to talk about what we call recognition and measurement. Recognition and measurement of financial instrument. Recognition and just measurement of financial instrument. How do you recognize them? Now listen. All financial instruments, whether it's a financial asset or it's a financial liability, whether to the borrower or to the investors, all of them should be measured at their fair values. That means the day you entered into that contract, that means on that initial recognition, all of the stakeholders, both the borrower and the lender, should recognize that financial asset or that financial liability at its fair value. All financial instruments should initially be recognized at their fair values. Let me give an example. You bought some 10,000 shares of company A at a time when the market price of the shares was 50 shillings. So you spent 500,000 shillings to buy 10,000 shares. So in your books, you as company B, you will have an account called investment in shares of A, which will have cash 500,000. So that way, you have recognized it at its market value, which is the same as fair value, Good. But then the question is, how will you remeasure it at the end of the year? How will you remeasure it at the end of the year? By the end of the year, at what value are you going to carry down? So that's what I want to talk about. Otherwise, I've said, on initial recognition, all financial instruments should be measured at their fair value. Subsequent measurement, now listen, subsequent measurement now depends on the classification. After you have recognized the initial, after that, how do you recognize the financial instrument? I've said subsequent measurement now depends on the classification of the financial instrument. In other words, is it a financial asset, or is that instrument a financial liability? If it's a financial asset, like I've discussed for company B, which they bought the shares, then any financial asset can be remeasured. Any financial asset can be remeasured in any one of the following three ways. Any financial asset can be remeasured in any one of the following three ways. One, it can be measured at amortized cost. It can be measured at amortized cost. Two, you can also measure it at what we call at fair value. At fair value through OCI. That means at fair value through other comprehensive income. Three, I'll talk about in a short while. Three, you can also measure it at fair value through P&L. So, any financial asset, I've told you initially it should be recognized at fair value. Subsequent measurement now depends on the classification. Is it a financial asset or is it a financial liability? If it's a financial asset, I have said it can be remeasured in any one of the following three ways. One, at amortized cost. We shall talk about how to compute the amortized cost. Two, at fair value again. Initially, you measured it at fair value. By the end of the year, again, you are measuring it at fair value. But listen this time, but the change in fair value, you take it through OCI. That means through other comprehensive income. Like this investment that you bought for 500,000. It could be one where you are measuring it at fair value. Again, maybe the market value by the end of the year is 600. So there's a gain of 100,000. That gain of 100,000, you take it to or through OCI, other comprehensive incomes. Of course, listen, you have done the topic called published accounts in your financial reporting. So you know when I say other comprehensive income, it means, listen, it means once you prepare your normal income statement, you remember, once you get your profit after tax, that's what we call the normal income statement. Then, if the examiner used to tell you to prepare a statement of comprehensive income, then you used to come and now say here, other comprehensive incomes. Other comprehensive incomes. You remember that? Good. One example of what you used to give, as an example of other comprehensive income was revaluation. Maybe there was a revaluation of fixed asset. Maybe there is a gain on revaluation of fixed assets. Whatever it is, that is just one example of what you used to put there as one of the examples of other comprehensive income. Now we are adding another one, that if your company or if your financial asset is one that should be measured by the end of the year at fair value through OCR, like I was assuming that you remeasured it at 600, the original value was 500. That 100,000 extra, you take it through OCI here. That's where you bring it. That is, we shall discuss which kind of assets are these. But the point I'm trying to say is that if it is one that should be measured at fair value through OCI, it means that whatever is the change in fair value, that change in fair value should go through other comprehensive income. Don't take it to the P&L. It's a gain, yes, but don't take it to the P&L. No. Alternatively, there are other financial assets that again we shall be measuring them again at fair value by the end of the year. But this time again, the change in fair value, now you take it to the profit and loss. Like if the fair value was 500 at the beginning, by the end of the year it's 600, there is a gain of 100. That gain could also be taken through P&L. So we shall look at which kind of assets are these that should be measured at fair value through P&L, fair value through OCI, at amortized cost. And that's what I want to talk about now. So now you know that there are three ways in which financial assets can be remeasured. Three ways in which financial assets can be remeasured. Sometimes you are told to explain. You are told a question like this: state how financial assets should be recognized. Initial recognition, explain the treatment of financial assets at initial recognition and subsequent measurement. I've told you all financial instruments should be measured at fair value. Subsequent measurement, I've told you, depends. Now, let me start with financial asset first. Before I talk about financial liability, let me talk about financial asset. We have said there are three ways in which financial assets can be remeasured. Let me first explain them. Financial assets. We have said either it can be measured, it is one where you can measure it at what we are calling at amortized cost. That's one way, at amortized cost. That's one way. The second way we have said is that a financial asset can also be measured. Number two, we have said financial asset can also be measured at fair value through OCI. That's the second way. The third way a financial asset can be measured is one, again, at fair value through P&L. Good. So these are the different ways in which a financial asset can be measured. Now, what kind of financial assets are these that should be measured at amortized cost? Now, let me start. I go back. I told you, as a company A, you wanted to raise finances. You decided you're going to raise finance by issuing this 10% bond. Let's call us 10% bond, whose nominal value may be 200 million. You, as company A, you wanted to raise funds, so you issued a 10% bond whose nominal value is 100 million. Or you issued a 10% debenture, let us assume, whose nominal value was 100 million. Now, you B, as an investor now, you bought either of them, whichever. Let's use the bonds. By you buying the 10% bond, listen, it is obvious that these bonds will guarantee you a fixed return every year. If you bought a 10% bond whose nominal value is 200 million, obvious you will be getting what we call interest income of 20 million every year. Listen. 2, you also know as an investor, on the day the bond will mature, maybe after 5 years, 10 years, whichever, I'll be given back my principal. That is the 200 million. Okay? So I hope you can see already that bond or that debenture has that kind of characteristic. So listen to this now. For a financial asset to be measured or to be remeasured at amortized cost, there are two conditions that that financial asset should have. So what are the conditions? Now listen. Number one, for a financial asset to be measured at amortized cost, it must be one, listen, that is held to maturity. Listen, it is one that is held to maturity to collect contractual cash flows. That means you as an investor, when you are buying this bond, the 10% bond, your aim is to hold it or keep it until it matures. And you are keeping this so that you collect the contractual cash flows. What are these cash flows? I've already mentioned them. Every year you will be receiving 20 million interest. Then in the year of redemption, I've told you, you will be paid your principal. So that's condition number one, that this is a financial asset which is held to maturity to collect contractual cash flows. Number two, the cash flows are, these are cash flows are for payment. Cash flows are for payment of interest and principal. The cash flows that you are collecting, those contractual cash flows, they are for payment of interest and principal. So if you as an investor, you have a financial asset which meets these two characteristics. One, you are holding it until maturity to collect contractual cash flows. And number two, those cash flows are for payment of interest and principal. Then you should remeasure that kind of an asset at its amortized cost. Listen, how to calculate the amortized cost we shall discuss later. But now you know which kind of financial assets are these that should be remeasured at amortized cost. Good. What about those which should be remeasured at fair value through OCI? Now, for that category, there are two subcategories. For that category, there are two subcategories. For that category, there are two subcategories. One is what we call for debt instrument, or debt instrument, and number two is what we call for equity instrument. May I put it clear? For equity instrument. Listen, meaning there are those financial assets you as an investor you can buy which are of debt in nature. They are of debt in nature. Like the bond, the debentures, those are for debt instrument. We call them debt instruments. There are financial assets you may have which are of equity. That means they are of shares in nature. We call them debt equity instrument. Good. So for this class, at fair value through OCI, we have those two subclasses. Okay? Good. Just a minute. Just give me a minute. Okay. So we are saying, which kind of financial assets are these that should be measured at fair value through OCI, and which, just a minute. Okay, so let's continue now. Now, for the financial instrument to be measured at fair value through OCI, if it is, listen now, if it's a debt instrument like the bond or the debenture, again, it has to have, listen, it has to have two characteristics. That means the conditions are, number one, for this financial asset to be measured at fair value through OCI, number one, it is one that is held to collect, listen again, one that is held to collect contractual cash flows. Listen carefully, I want to add something there. To collect contractual cash flows and to sell before maturity. Meaning, listen, you as an investor, you bought this bond with an aim of, yes, collecting the cash flows, that's okay, but your aim is not to keep it until it matures. You are company B, listen, or investor B. Company A, which was issuing the bond, they issued this bond through the stock market, just like any other company would issue the money or the bonds through the stock market. You as an investor, you went to the stock market and you bought the bond. But your aim is to wait and see if the market price of the bond goes up, I sell it and make a gain. I don't have to keep it until it matures. No. My aim is to sell it if I gain. So you are holding it, yes, to collect the contractual cash flows and to sell before maturity. I'm not saying you must sell. It may not favor you, so you might keep it until it matures. But your objective is to sell before maturity. Therefore, we are saying that's one. Number two, these cash flows again that you are collecting, the cash flows are for payment of interest. The cash flows are for payment of interest and principal. The cash flows are for payment of interest and principal. Now, so I hope you have managed to see the difference between those measured at amortized cost and those measured at fair value through OCI. They are both bonds. They are both debentures. But for the first category, I told you, your aim is not to sell. Your aim is to hold it until maturity. The second one is that your aim is to sell it anytime I make a gain, I sell it. Okay? Good. So that's what we are saying. Number one, it is one which is held to collect contractual cash flows and to sell before maturity. Number two, those cash flows are for payment of interest and principal. Good. Now we go to the third category as the other for the equity instrument. You bought the shares like I was mentioning earlier. You bought the 10,000 shares at 50 bob each. That was the market value. Now, if you as an investor, listen, if you as an investor, you are not intending to sell the shares at all. You are not intending to sell the shares at all. You want to keep them for long term. Then they are equity instrument and you are not aiming to sell them at any time, you want to keep them for long term, then they should, listen, they should be measured at fair value, and the change in fair value, you take it through what? OCI. So we can now say here, these are for shares that are not for trading, that are not for trading, i.e., we are saying for long term. You are buying the shares, aiming to keep them for long term. So those shares, you will measure them at fair value initially, again at fair value at the end of the year, but the change in fair value, we are saying, take it through other comprehensive incomes. Good. So that is category number 2. Those financial assets that should be measured at fair value through OCI. It's either a debt instrument or an equity instrument. For a debt instrument, it must have the 2 characteristics. 1, you are holding it to collect contractual cash flows and to sell before maturity. Number 2, those cash flows are for payment of interest and principal. Then the other subcategory is for equity instrument. That means for those shares which you are buying as an investor, but they are not for trading. They are for keeping for long term. Good. Finally, what are these financial assets that should be measured at fair value through P&L? Which should be measured at fair value through P&L. Now listen, it is for any other financial asset, which cannot obviously be classified in any of the other categories. If you have a financial asset that cannot be classified under amortized cost or under fair value through OCI, then it is required that you still measure it at fair value, but whatever is the change in fair value, take it through P&L. Take it through P&L. Of course, I hope by now you can think of an example. Of such a financial instrument. The most common one could be if you buy shares and your aim is to buy them for speculation, for trading. You are buying them today in the stock market with an aim of selling them anytime you gain. That kind of financial asset, you cannot measure it at amortized cost. You can't measure it at fair value through P&L because through OCI, because it's not for long term. It's for speculation. So that kind of a financial asset should only be measured at fair value through P&L. That's where you keep it. Good. So here we can even say, e.g., shares for trading. Shares for trading. You buy shares for trading, that's where they will classify them. Good. Now, before we talk about liability, no, maybe I can talk about it so that we put down everything now. How about liabilities here? We have discussed how to measure financial assets. What about financial liabilities? Now, when it comes to financial liabilities, listen, it is obvious we are now not looking at it from the point of view of the investor. An investor cannot have a financial liability. He has a financial asset because he bought those investments. Now we are looking at it from the point of view of the borrower who issued the bond. How will he recognize it at the end of the year? Again, listen, all financial liabilities, all of them should be measured by the end of the year at amortized cost. That's the most common way. How to calculate it? Don't panic. We shall calculate it in a short while. Listen, I've said financial liabilities should be measured at amortized cost. Listen, except for except for those financial liabilities which are for trading. They are not common. They are not common. Listen, not common in this sense. Mostly, whenever a company normally issues bonds or they issue debentures, they are issuing those bonds or they are issuing those debentures to finance their business. So the company issued the bonds through the stock market, or they issued whatever through the stock market. They were issuing them to finance their business. But if a company issues those bonds, listen, a 10% bond whose nominal value was 200 million, if they issued it at par, they must have received 200 million. Listen, if their aim is to wait and to see the market price of the bond going down in the stock market, and then they redeem the bond, they buy back the bond. Listen, assuming by the end of the day or after 2 months or whatever, the market price now of the bond is 180. Remember, when company A was raising the finances, they received 200 million from the bond. But now the market price is 180. They can pay back the 180 and redeem the bond. In other words, they can redeem those bonds. They will gain the 20 million. They will gain the 20 million. Now listen. So we are saying, if a company does that, which is rare, normally whenever a company issue bonds, they are issuing them to raise finances. And so we are now saying, in case it is for trading, then they should be measured. Listen, they should be measured at fair value through P&L. At fair value through P&L. So initially you measured them at fair value. If it's for trading, that's a financial liability. If it's for trading, it should be measured again at fair value, but the change in fair value should be taken through P&L, Otherwise, in most cases, financial liabilities should be measured at their amortized cost. Good. Now, let's put down the summary of what we have already said. We are discussing the topic of recognition and measurement. Let's put down the summary note now. Let's put down the summary note on that now. Let's put down the summary note on that. So, sema hivi, andika summary as a subheading, recognition and measurement. Recognition and measurement of financial instruments. Recognition and measurement of financial instrument. Recognition and measurement of financial instrument. Then you say this. All financial instruments should be recognized. All financial instruments should be recognized initially at their fair values. All financial instruments should be recognized initially at their fair values. At their fair values. At their fair values. Will you stop? Will you stop? Subsequent measurement. Subsequent measurement. Subsequent measurement. Subsequent measurement. After initial recognition, subsequent measurement. After initial recognition, subsequent measurement after initial recognition depends. Subsequent measurement after initial recognition depends on the classification. Depends on the classification of the financial instrument. Depends on the classification of the financial instrument. depends on the classification of the financial instrument. Another paragraph. The following are the three ways in which a financial asset should be remeasured. The following are the three ways in which a financial asset should be remeasured. The following are the three ways in which a financial asset should be remeasured. Sorry for the blinking. I don't know, the camera has something. Okay. So I'm saying the following are the three ways in which financial instruments or financial assets should be measured. Number one, at amortized cost. At amortized cost. At amortized cost. Number two, at fair value through other comprehensive incomes. At fair value through other comprehensive incomes. At fair value through other comprehensive incomes, in bracket OCI. At fair value through other comprehensive income, in bracket OCI. 3. At fair value through P&L. 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 Okay. Then, with that now, I don't think we need to put down any other summary. Just come and copy this now. Come and copy this chart. Come and copy that chart. We have said financial asset. You classify it into three categories. That is at amortized cost, at fair value through OCI, and at fair value through P&L. Once you have those three branches, then you come down and give the conditions for each. To have those three branches first, the starting is the financial asset. Then you can branch into three: at amortized cost, at fair value through OCI, and at fair value through P&L. Have it that way. Good. Then I move up. Hope you are through now. Then you can say, for at amortized cost, that's where we are starting. At amortized cost, we gave those two conditions. You can see them there. At amortized cost, we gave those two conditions. Number one, you can write. Number one, at amortized cost, the first condition was held to maturity. Held to maturity to collect contractual cash flows. Held to maturity to collect contractual cash flows. Held to maturity to collect contractual cash flows. Number two, cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. So sorry for the blanking of the camera. I don't know what's happening today. I'll correct it after this. Just a software issue. Okay. So I hope you are through with number one, which we are saying at amortized cost. Condition number one, held to maturity to collect contractual cash flows. Number two, cash flows are for payment of interest and principal. Good. So I hope you are through with that. Let me roll the chart. For the second one, at fair value through OCI. Then I have two subcategories there. You can also have those two. Have those two subcategories. Have those two subcategories. Have those two subcategories. One for debt instrument. This is for debt instrument. For debt instrument. This is debt instrument. And number two, the second sub-branch is for equity instrument. Okay, once you're through with those two sub-branches, now we can give the conditions for each. Now we can give the conditions for each. You can come below that for debt instrument. For debt instrument, put the condition. Number one, held to collect contractual cash flows. Held to collect contractual cash flows and to sell before maturity. Held to collect contractual cash flows and to sell before maturity. This blinking is increasing so much today. Okay, I'll correct it. Don't mind, so long as you're able to see what I'm writing. Okay, so number one, we have said held to collect contractual cash flows and to sell before maturity. And to sell before maturity. And to sell before maturity. That's important. Number two, cash flows are for payment. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Cash flows are for payment of interest and principal. Good. So that is it. I hope you are through with those two conditions for debt instrument. We now go to the subcategory of equity instrument. For equity instrument, put it down. You come and say there, for shares that are not for trading. 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 Okay. That is IE, andika IE for long term. IE for long term. I've said for shares that are not for trading, IE for long term. Then you can now come to the last category, the one at fair value through P&L. The one at fair value through P&L. The one at fair value through P&L. Andika below that, for any other financial asset. For any other financial asset, e.g. shares for trading. For any other financial asset, e.g. shares for trading. Okay. I don't want to touch the computer for the correction of the camera. I might make it worse. Let me now go by what it wants for now. But it normally doesn't behave this way. Sorry for those blinkings. So long as we continue and learn. Because if I touch the software, that might worsen and it might take me a bit of time to correct Sawa. So I'll correct it after this. Okay. So let's continue. Now, listen. So I'm now through. Listen carefully now. I am now through with the financial asset we have discussed. financial assets. How to remeasure them. I hope you are through with the copying. Now we move to financial liabilities. So have another subheading, financial liabilities. Financial liabilities. We want to discuss them again. Financial liabilities. Oh my. Oh my, today. Okay, let's hope it doesn't blank me completely. Okay. Now, I've already mentioned it, that all financial liabilities initially at fair value, subsequent, I told you, at amortized cost, unless they are for what? For trading. So put down the statement. Financial liabilities should initially be measured. Financial liabilities should initially be measured at fair values. Financial liabilities should initially be measured at fair values. At fair values. Oh man. At fair values. Then you say this. Subsequently, they should be remeasured. Subsequently, they should be remeasured at. Subsequently, they should be remeasured at. Oh my. Subsequently, they should be remeasured at their amortized cost. Subsequently, they should be remeasured at amortized cost. Subsequently, they should be remeasured at amortized cost. Except for. Subsequently, they should be remeasured at amortized cost. Except for. Financial liabilities that are for trading. Except for financial liabilities that are for trading. Whereby, except for financial liabilities that are for trading, whereby this should be remeasured. Whereby this should be remeasured at fair value through P&L. Whereby this should be remeasured at fair value through P&L. Good. Whereby this should be remeasured at fair value through P&L. Good. Okay. I'm hoping it will survive. I don't want to touch the computer. If I touch it, it might give me more hell. Okay, let's just persevere. Sorry for now. These are technical issues, you know, they happen. Now, let me proceed now. Let me proceed. Now, so I want to start with financial liabilities. How do we calculate the amortized cost? How do we calculate the fair value first and the amortized cost? That's what I want to talk about now. Listen. Suppose you as company A, you are the company issuing the bond. Suppose you issued the 10% bond. Listen, you issued the 10% bond whose nominal value was 200 million. That is the nominal value. 200 million. Now, for you to raise this money, you decided as a company A that you will issue this bond at a discount of, let's say, 5%. Because you wanted to raise money, so you told the investors, yes, I'm issuing you a bond of 200 million, but I'm giving you at a discount of 10%. So 10% of 200 million, or let's say 5% of 200 million, is about 10 million. So you give me 190, but when it comes to the year of redemption, I'll give you 200. So if you issued the bond at a discount, then you come and less the discount. Let us assume 5%, that will give you 10 million. So today, listen, as an investor, you received 190. As an investor, you received 190. But it may also happen that for you to raise these funds, you as company A, you had to hire lawyers to prepare whatever documents, you had to hire accountants to prepare the prospectus and so on. Listen. And so you ended up incurring, what we call issue cost. So if there were any issue cost that you incurred or flotation cost, let us assume of 5 million, listen, then effectively from this bond, you received how much? Not 200, but you received 185 million. That 185 million, which is the net proceeds from the bond, that is the amount we now call the fair value. The initial fair value is that net proceeds. That's how we shall be determining the fair value of a financial liability. You get the net proceeds. I've assumed that we have issued a bond whose nominal value is 200 million. I've assumed we have issued it at a discount of 5%, which is 10 million. I've assumed the issue cost was 5 million. So you as company A, you effectively received 185 million. You received 185 million. So that is the fair value on initial recognition. Listen, what about in the subsequent years? How do you remeasure it? Tumesema, financial liabilities should be measured at their amortized cost. I don't know whether to touch the computer or not to touch it because now it's blinking often, so often. I hope you are not being interfered with. Ebu chat and feel if you are being interfered with the blinking, ama we can just continue. If I touch, are you okay? So that I know that I correct it after this, or I try and risk and touch the screen, the software. Are you okay so far? Are you okay so far? You don't mind the blinking? Let me know. Let me know. Oh, it's okay. We continue. Sawa. 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 If you're okay, sawa. Most important is what I'm writing. And if you can hear, fine. Sorry for now. It doesn't behave this way. So let me continue now. Okay, we are okay. So I was saying this. When you are measuring a financial liability, what is the initial recognition? Fair value. How do we get the fair value? You get the net proceeds from the bond. If it's a debenture, whatever it is. So go through the question, find out what is the nominal value of the bond. Could they have issued it at a discount? And was there maybe a flotation cost or an issue cost? Okay? Once you net over everything, whatever you remain with, that becomes the fair value. Now, to compute, it's becoming too much. My. It's okay. Ah. Ay, 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 ay. Let me try and risk. Let me try and risk. It's becoming too much. It has become too much. Just a minute. Just a minute. Wow. Okay, are you able to see me now? Are you able to see me now? Let's continue. You chat yes. I think I've rectified it. Chat and say yes. Chat and say yes. Yes. Good. Thank you. So let me now. Good. Thank you. So let me take you back now. Just give me a minute. I reconnect one thing here. Just give me a minute. It was giving us a problem. Okay. Sawa. So you are saying you're okay now? Chat and say whether you're okay now. We continue. You chat and say whether we are okay now. You chat and say yes. Andika okay. If you are hearing me, write the word okay. Write the word okay so that I know I'm communicating. Write the word okay. If I am communicating, write the word okay. We continue. I was saying, okay, good. Thank you, 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 thank you. Good. Now we can continue. I think I've rectified. Thank you. Good. I had to take a risk. I had to take that risk. Good. Good, 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 good. Thank you. Yeah. So let's continue now. I had to take that risk because I felt it is becoming too much. Okay? Now, listen. So I was saying this. To calculate the fair value on initial recognition, I said you get the fair value, meaning the net proceeds. I was giving you an example of buying a bond whose nominal value is 200 million. The company that issued it, we were saying it was issuing it at a discount of 10 million, and they had to raise these finances. They had to incur some issue cost, which is 5 million. So effectively, I told you, listen now, effectively, I told you they received 185 million. That is the fair value on initial recognition. Good. Subsequent measurement, now I said, you will have to calculate what we are calling the amortized cost. To get the amortized cost of this bond, it will have to prepare what we call an amortization schedule or amortization schedule. Sound is not flowing. Is the sound clear to the others? Hey, hey. Now it is the sound. To the others, am I loud and clear? To the others, is the sound clear? Somebody says that is John. Says the sound is not clear or not flowing. Is it clear to the others? Yes or no? Sound. Andika, loud and clear. Loud and clear. If the sound is loud and clear, write the word loud and clear. Sound is clear. Good. Kwa hivyo maybe John has an issue. Good. Thank you. Fine. Okay. Good. Fine. Thank you. It's clear to most of the people. Good. Now listen. Good. So I was saying, to calculate the amortized cost at the end of the year, listen now. To calculate the amortized cost at the end of the year, we have to prepare the amortization table. You have done finance. So you need a column for the year. You need a column for balance brought down. You need a column of the finance cost. You need a column of what we call cash paid. And you need a column of the balance carried down. Listen. Year 1. You began the year with a financial liability of 185 million. 185 million. Listen. To calculate what we are calling the finance cost, which we also call the interest charge for the year, listen carefully now. You issued a 10% bond. True. That 10% is what you call in finance the coupon rate. It's what you call the coupon rate. To calculate the finance cost, we normally are required to use what we call the effective interest rate. That means the required market rate of return. The question will tell you what is the effective interest rate in the market. So, let me assume that the question tells you the market rate of return or the effective interest rate is 12%. Now, 12% is what you will now use to compute the finance cost. To calculate the cash paid, listen, to calculate the cash paid, you will be using the coupon rate. I told you, you as a company, you issued a 10% bond whose nominal value is 200 million. Listen, every year you will be repaying the bond at 20 million. 10% of 200 is 20 million. So every year you will be repaying the interest, not the principal. You will be servicing the interest by 20 million. So when you are computing the cash paid, you compute the cash paid using the coupon rate on the nominal value. Good. So let's continue now. So 185 million is the fair value initially, or the liability initially. Multiply that by 12% of 185 million. That gives me an amount of 22.2 million. For purpose of illustration, let me assume 22 million for purpose of illustration. Cash paid, I have told you, it is 10% of the nominal. 10% of the nominal, that comes to 20 million. That's what you are paying. So by the end of the year, what is the amortized cost by the end of the year? It will be, if I take 22, I minus 20, that gives me a positive 2. I add to 185, that gives me 187. Okay? I bring down the balance by the beginning of year 2, 187. I take 12% of that to be the charge, 12% of 187. That gives me something like 22.44. Let me assume for purpose of illustration that is 23. Then I pay 20 million. How much am I carrying forward as the amortized cost? I'm carrying forward 23 minus 20, that's positive 3. Positive 3 plus 187, that gives me 190. Then I come to the third year. Third year, 190. I am assuming 12%. Let me assume for now. Let me assume it gives you 24 interest. Pay 20. You're carrying down a liability of how much? That is 24 minus 20. That is 4. Plus 190. That's 194. I bring down the balance by the beginning of the fourth year. 194. Let me assume you take 12% of that and you get 25 for purpose of illustration. You pay 20 million. What are you carrying forward? It will be 25 minus 20, that's positive 5. I add to 194, that gives me 199. Then let me assume, listen, I want to assume that the bond will mature after 5 years. So we are in the year of redemption now. So you come and say 199, 12%, that is, let me assume 26. Listen, that year you still pay 20. And listen now, it is the same year you are redeeming this bond. You are redeeming this bond. So the question will tell you, are you redeeming the bond at par or are you redeeming it at a premium? For now, let me assume that the question tells you you are redeeming it at a premium of maybe, let me assume you are told you are redeeming it at a premium of 2.5%. Meaning, you, on top of the nominal of 200 million, you pay an extra premium of 2.5%. 5% we saw it as 10 million. 5% of 200 million, you remember we saw it as 10 million, which means half of 5% is 5 million. 2.5% of 200 million looks like 5 million. Listen. So in the year of redemption, I'm assuming the question tells you are redeeming it at a premium of 5%. So you will pay an extra 5 million. So that year you redeem at 205. 200 is the nominal plus the amount of the premium on redemption. Good. Once I do that, there should be no balance carried down. There should be no balance carried down. Good. Now, let me confirm for the sake of practice, there should be no balance. But if I take 199, I add 26, I minus 20, I minus 205, good. It leaves me with 0. That's okay. Now, that is your amortization schedule. Listen. So these balances I'm carrying down are the figures we are calling the amortized cost. Are the figures we are calling the amortized cost. Now, if the question tells you, which of course it should ask you, if to prepare is to prepare what we call the profit and loss extract for each of the 5 years, and maybe the balance sheet extracts. So if you as company A, you are to prepare your P&L extracts, profit and loss extracts, what will go to the income statement? What will go to the income statement? You will need a column for the year. And of course, what will go to the income statement is the finance cost. Is the finance cost. Year 1, year 2, year 3, year 4, and year 5. Of course, we saw in year 1, the interest charge was 22. That's what you take to the income statement. That is 22. Second year, what did we charge? 23. 24, you remember? That was what we were assuming. 25, and it was 26. That's all that will affect, that's all how it will affect our income statement. Okay? Good. Now, what about in the balance sheet? What about in the balance sheet? If you are told to prepare balance sheet extracts, then you need a column for year 1, year 2, year 3, year 4, and year 5. Now listen. In each of those years, there will be somewhere among the long-term liabilities, or what we call non-current liabilities, There you will have what we are calling a 10% bond. Then somewhere among the current liabilities, there also you will have what we call a 10% bond. So let's go and classify our liabilities. Listen to the argument now. I go back to my table. By end of year 1, I am carrying down a liability of 187 million. This bond will be redeemed at the end of the 5th year. It will be redeemed at the end of the 5th year. So it means I am not paying anything of the principal. The 20 I'm paying every year, I am only servicing the interest. I'm not paying anything of the principal. I hope once you get that the 20 you are paying is not the repayment of the principal amount. You're only servicing the interest. This bond will be redeemed in the 5th year. So if by end of year 1, I am carrying down a liability of 187 million, listen, I will ask myself, how many more years do I still have for me to pay that bond? For me to pay this 187 million, how many more years are still there? It means I have a 2nd year to go, 3rd year, 4th year, and the 5th year. Those are 4 more years to go. So that 187 will take me more than a year to pay. So in the balance sheet of year 1, that 187 will go to the balance sheet of year 1 as a long-term liability, that 187. In that year, there will be no current liability. 2nd year, we are carrying down a liability of 190. Again, I ask myself, how many more years are there to go for me to pay that amount? I still have the 3rd year, the end of the year 2, I still have the 3rd year, 4th year, and the 5th year. Those are 3 more years to go. So because I have 3 more years to go, then I take it again as a long-term liability. How much? 190. So in the balance sheet of year 2, that 190 is a long-term liability. There will be obviously no current liability. 3rd year, what are we carrying down? 3rd year, we are carrying down 194. Again, I ask myself, how many more years are still there for me to pay that 194? Don't forget, everything will be paid in the 5th year. So by end of year 3, I still have another 4th year and the 5th year. So by end of year 3, I still have 2 more years to go. That means that 194 will be classified again as long-term in the 3rd year. That 194 will be classified as a long-term by end of the 3rd year, meaning no current liability. Good. Look at year 4 now. Look at year 4. Year 4, we are carrying down a liability of 199. This 199 must be paid by end of year 5, which is next year. So it means in the next 1 year, I must pay this 199. So by end of year 4, I still have only 1 more year to go for me to pay this 199. So I'll consider it, by end of year 4, I'll consider that 199 as a current liability, not long-term. I still have only 1 more year to go. So I come and classify that as a current liability. Nothing long-term in that year. So we come and say that 199 is current. In the 5th year, there is no balance carried down at all. So there is no long-term, no current. Good. So I've explained to you how we shall be calculating the amortized cost of a financial liability. Also explained to you how we shall be calculating the fair value of a financial liability. To get the fair value, I've told you get the net proceeds. Get the net proceeds from the issue of that financial instrument. Get the net. Get the nominal. If there's any discount you're issuing, you minus. If there's any flotation cost, or issue cost, you minus, get the net proceeds. That net proceeds is what I've said becomes the fair value, becomes the fair value. Then I've said subsequently, now you measure it at its amortized cost. To get the amortized cost, I've said you prepare the amortization schedule. Then I've told you, you now measure it at amortized cost using, listen, using the effective interest rate, using the effective interest rate. To get what? To get the finance cost or the interest charge, use the effective interest rate. Good. Now, I have no time to put down an example on this, then we do another one. You will allow me to stop there for today. You will allow me to stop there for today because I want to talk to new students for now. I want to talk to them a little bit. For the guys who are continuing with us, we shall meet next time where I'll now do an example on this. Then we do a past paper question. Then we do a past paper question on this. Then we also look at how to measure financial assets and so on. And also develop the topic. We still have a lot. We have not yet finished the topic yet. We still have a lot to do. Okay. So you allow me to stop there for today. I'll continue there from there next time. Now, for the new students, listen. For the new students who are here today and you would wish to continue with us for advanced financial reporting, we normally have either early morning classes, I'm talking to the new students now, or we have evening classes. Our early morning classes normally starts from 5:30 in the morning to 7 a.m. every Monday, Wednesday, and Friday. Sorry, that's early morning, Friday. Monday, Wednesday, and Friday. For evening classes, we always have them from 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday. Now listen. Kindly repeat how to arrive at the 205. No, 205, sorry, that is who? Kennedy. Listen, let me repeat for your sake first. I told you the question will tell you. Listen, the question will tell you how the bond is being redeemed. If the question tells you you are redeeming your bond at par, remember we issued a bond whose nominal value was how much? 200 million here. We issued a bond whose nominal value was 200 million. So if the question tells you you are issuing it redeeming it at par, then I would still have paid now here 200 million. Are you there? If you are redeeming it at par. I'm assuming the question tells you you are redeeming it at a premium. And let's say the question tells you you are redeeming it at a premium of 2.5%. At a premium of 2.5%. I told you 2.5% is 5 million. Or the question might tell you, you are redeeming it at a premium of 5 million shillings. At a premium of 5 million, they give you the amount. So over and above the nominal here of 200 million, you add the extra premium. If it's 10%, 10% of 200 million is 10 million. If it's 5%, no, 10% is 20. If it's 10%, 5% is 10 million. If 2.5%, it's 5 million. So yeah, I was assuming that the question is telling you you are redeeming it at a premium of 2.5%. That's 5 million. It could be that you're given the amount of the premium. Yeah, you are told you are redeeming it at a premium of 5 million. So you just take the nominal 200 plus the premium. I hope, Kennedy, you are okay now. Kennedy, are you okay of how we are getting the redemption amount? It's an amount we assumed, but the question will guide you as to how you are redeeming your bond. Okay. Okay, Kennedy? Good. I hope you're okay now. So, I was talking to the new students. Now. Let me continue. So, I was saying, either early morning or evening, if you want to continue with us. Okay? Then I said, for the evening, we have it from 8 p.m. to 10 p.m. in Monday, Wednesday, and Saturday. Okay? Then I said, now, our system is such a way that in case you miss a class, let us assume it's an evening stream, and you miss a class on Saturday, does it mean that that class is gone? The answer is no. You can still go back to the group where the link was posted, and you will be able to click on the link and you'll be able to watch the video of the class that you missed. Okay? So anytime you miss a class, don't panic. The video is still waiting for you in the group. Doesn't matter whether it's early morning or evening. The video does not expire. Good. Now, if you're not available in the early morning and you're not available in the evening, then you can still buy what we call the pre-recorded videos. Where you buy all the videos for the syllabus at once, all of them at once. Then you listen to them at your own free time, at your own pace. Okay, thank you, Kennedy. You're saying you're okay now. Good. Now, so that is the program for advanced financial reporting, either early morning or evening, or you can buy the pre-recorded videos. We are charging 4,000 shillings, but you can also pay in installments. Now, if you want to reach me, then you can call me on this number, 0722 65 8875. If you want to reach me, you can reach me on 0722 65 8875. You can call me anytime. We can talk. That is the program for advanced financial reporting. Now, you may also have friends who are doing financial reporting of the intermediate level, or what used to be called financial account reporting section 3. If you have friends who are still doing it, please tell them that we also teach financial reporting. The classes there, I think, are Tuesday, Thursday, and Friday in the evening. Okay? Also, the same cost, 4,000, they can pay in installment, whatever it is. Also, we are also teaching financial accounting for the students who are doing foundation level, or what used to be called section 1. We are also teaching financial accounting. That is also for ATD1. You know there is accounting in ATD1 and accounting in ATD2. Good. That is our program. Now, when you join the class now, we shall still give you the videos of all the previous classes that you have missed. Don't panic as to whether you'll miss the classes. I'll give you the videos of all the previous classes that you have missed. So you'll get the videos of all those classes. Okay? So that is it. The other thing I appeal to you is that you please subscribe. Please subscribe to my YouTube channel so that you will be notified every time we post new videos into the YouTube channel. Our YouTube channel is called CPA Joseph Njuguna. That's the name of the YouTube channel, CPA Joseph Njuguna. Good. Maybe I think I'm through now, unless there's a question, maybe from any new students who wants to comment on something, Otherwise, sorry for the blinking that was there earlier. We have taken a risk and corrected it. Okay. So unless there's a question or a comment from a student, especially maybe the new ones, we want to stop there for today. We pick it up from there next time. So you either join early morning or evening, or you can buy what we call the pre-recorded videos. Okay. Any comment from any new student who would want to say something before we close the class for now? For my normal students, we shall continue with the normal class as usual. I'll give the summary and we shall do, I've told you what we shall do next time. Okay. So if there is no comment, any comment from either a new student, today's topic has synced well with system issues. Thanks, Mwalim. Thank you. Thank you, Kiama. I hope you have understood how to measure financial liabilities, financial assets, blah, blah, blah. Good. Any other comment? Ama, we can close the class now. Good. So unless there is any other comment, we can say good night for now. Good night. For the new students, I hope you will call so that you continue with us. Thanks. Okay. Bye for now. Bye for now. So let's call it a day. Good night.